Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Nike Q3 earnings are out and they're not great in terms of Q4 guidance, in terms of the early guidance or indication of guidance we're getting for fiscal year 26. That's why the stock is down about 6.7% pre-market. Stock is down about 28% in the past year. And if you're a shareholder for the past 5 years or so, you're basically flat. This is off of the lows during the pandemic. So yes, there was a spike here. Sneakerheads had a lot of money. They bought a lot of Nike shoes. Demand outstripped supply for a bit of time, and Nike thought they could change their strategy to focus more on direct to consumer, focus less on wholesale partners. That was a bad idea, and now that's showing up in their results because the results themselves, while they beat expectations, aren't too great. And that's because anytime you see a 9% decrease in revenue, a 12% decrease in Nike direct revenues, a 7% decrease in wholesale revenues, gross margins shrinking by 330 basis points, that's not a good thing. It doesn't matter that they beat what the market expected. Yes, maybe the market expected a 10% decrease in revenue. They hit a 9% decrease in revenue. Amazing. Anytime you see a company like Nike shrinking by this much, shrinking by more than they shrank during the pandemic, shrinking by more than they shrank during the 2008 recession, you're seeing a problem of sorts. And more worryingly is that the Q4 guidance they gave is probably worse than what the market expected, expecting to shrink by mid-teens in Q4 25, expecting gross margins to shrink by 400 to 500 basis points off of last year. That's another 1 to 200 basis points worse than Q3, than the 41.5% we're seeing right here. You're looking at their overall revenues in Nike Direct down 12%, like I said, but it's 15% in Nike Digital. Shows that they're really struggling on Nike Digital. They're also struggling on wholesale revenues. Shows that the decisions they made in 20 and 21 when demand outstripped supply to focus more on Nike Digital and focus less on wholesale allowed other competitors to take market share, to take shelf space from wholesale partners. And now that the supply outstrips demand, they're struggling. They have franchises that they overproduce. They have to sell at discounts now, and that's showing up in their overall revenue. And that's really the idea they have behind this win now strategy, is to get focused and really sell through some of the old stuff that isn't selling anymore, get new stuff out the door, and really become what Nike used to be. So as you look at this win now strategy, what is it exactly? It's ignite our culture through a focus on obsessing sport and getting back to winning. So basically, step one is nonsense. Accelerate a complete product portfolio driven by athlete insights. That makes sense, right? They overproduce certain things that people don't really want. Maybe they were just buying it because they thought they could sell it on the secondary market, because that's what was happening in 21, because the sneakerheads were out there buying up everything. So yes, that led to really good sales in 20 and 21. But if you overproduce things that people don't actually want, they're buying because they think they can resell it on the secondary market, it's not a good thing in the long run, as shown here. So it's a new product portfolio, a focus on running that's already showing up in some of the results, a focus on kind of getting their other franchises right-sized versus what they are today, because they're not really selling as much as they used to. Increase their investment in brand to deliver big, bold marketing statements. Again, Nike's already doing this, so this is nothing new. Nike's marketing budget is like double the revenue of most of their other competitors. You look at something like On Running, an up-and-comer that's growing at 20 to 30%. You look at Hoka, that's growing in the mid to high teens right now. Their revenue is probably 2 to 3 to 4 billion depending on the brand. Nike's spending like double that on marketing, if not more. Nike already has, 16 to 17% of the sportswear market share. So they're already spending a ton of money of marketing. This is nothing new. Yes, maybe their marketing has to change a little bit and become more focused, better, etc., and they'll do that and regain what they were in the past, get back to growth, etc. But you have to remember, as a shareholder, this is a marketing powerhouse already. This is what you're buying. You're buying a brand that markets itself well. So this isn't anything amazing. Invest in and empower our teams in key countries, in key cities, to win the ground game. Okay, super. Don't know what that means. And then elevate the marketplace through a more premium Nike Direct and an unwavering commitment to our wholesale partners. Obviously, a change from the prior leadership regime, which focused on Nike Direct versus wholesale. And that meant that they went to their wholesale partners and they said, hey, listen, if you want Nike in your stores, you got to give us a better deal, which meant the wholesale partners would have a worse deal. And the wholesale partners probably said, hey, I can get more money from some of these other up and coming brands that actually want to work with me versus Nike. And that meant that Nike lost some shelf space to these other brands that are now gaining market share. And then on the other side, yes, they're investing in Nike Direct. In the past, they're still doing the same, but now they're more focused on making Nike Direct, whether it's Nike stores or Nike.com, a more premium marketplace. It's not going to be stuff that's on sale all the time. It's going to be stuff that's full price, that's unique, that's awesome. And that means in the short term, that's going to lead to a decrease in sales as they sell through some of the stuff that they don't want on Nike Direct anymore. They don't want as much of on Nike Direct anymore. Same thing in wholesale stuff. It's like we have too much of certain franchises and we have to sell that at massive discounts, and that's not going to stop anytime soon. They talked about how that's going to be a headwind going into fiscal year 26 as well, which I think is unexpected to some investors and why the stock price is being punished. So as you look at overall results in various geographic areas, North America down 9% in footwear, up 7% in apparel. And this is actually pretty good if you look at how this looks against the prior quarter. They were down 14% in footwear, up 1% in apparel. So things are moving in the right direction. The problem, though, is in EMEA, Greater China, Asia Pacific, and Latin America, things are moving in the wrong direction. You went from -9, -5, and 2 to -11, -8, -15. Greater China, huge decrease, -12 and 1% growth in footwear and apparel, respectively, down to -17%. Same thing in Asia Pacific and Latin America. So North America starting to move in the right direction. Every other country internationally moving in the wrong direction. That's a problem because international revenue is 50% plus of overall revenue for Nike. International EBITDA is also 50% plus for Nike, and those are all down in the 30 to 40% range, whereas North America is only down -21%. So that's putting a lot of pressure. And as you think about America's standing in the world right now, other countries aren't loving what America is doing. So Nike, a very prominent American brand, will their sales internationally be impacted in a negative way from some of the things that our administration is doing and how that makes other countries feel about us? Probably. That's probably a negative for them. On top of that, you've got tariffs coming up that is going to impact your margins in North America. They already talked about how that's going to be an impact to Q4 and into the fiscal year 26. That's part of the reason their margins are decreasing another 100 to 200 basis points in Q4. They did talk about how that's the bottom end of their margins and they should start improving after that. But fiscal year 26 is still going to be impacted negatively from a margin perspective due to the tariffs, due to the fact that they still have some sell-through to get through on some of their oversupplied franchises, and that's going to move into their results in 2026. And from a valuation perspective, Nike still isn't that cheap. If you look at some of these comparisons against some of their competitors, you look at their PE ratios against, I wouldn't look at that too closely because it's being impacted heavily by their margin impacts. That's probably not a long-term thing. But from a free cash flow perspective, still kind of expensive, not that much cheaper than something like Decker Outdoor Corporation, which is growing in the mid-teens. Nike is shrinking at -10%, is going to shrink in the mid-teens in Q4 and probably grow in the low single digits in 26. That's kind of my estimate. You look at something like Anta, which is a big competitor in China, much cheaper than Nike on a free cash flow perspective. From a total enterprise value over revenue perspective, yes, they're cheaper than something like Decker, something like On, which is growing in the mid-20s, low 30s, depending on the year. But their margins are also being pressured quite a bit. They're having to sell a lot of stuff at a discount, and that's certainly impacting their valuation. So from a valuation perspective, let's take a look at that right now. And disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. So Nike, we've got a $106 billion market cap, $108 billion enterprise value. If you look at 24 actuals, a 6.2% free cash flow yield. If you account for the $1 billion or so in inventory benefit they saw that year, it's closer to 5%. Still a pretty good valuation versus historical norms for Nike. Historically, Nike has been in that 3 to 4 to maybe 5% range on a bad day. So to be in a 5 to 6% range, certainly a bad day for sure. And that's obviously the case when you're reducing your revenue by 10%, when your margins are shrinking by 4 to 5 to 600 basis points over their historical norms. So you're seeing that negative 10% growth, those margins being compressed in 25. What do you see for 26? For me, it's 1% growth for 26, margins expanding all the way up to 10.5% by 29, which is kind of their historical average. Then growth returns in 27, 5% growth, 4% growth, etc. One thing that worries me is if you look at their growth from 2019 to 25, you sort of exclude these years, which might have been an aberration due to the additional pandemic money, the additional demand from sneakerheads, the resellers, etc. Their long-term growth here back to 25, all the way to 25, back to 2019 is about 3%. So, is 5% too aggressive for a company that has grown at about 3% between 2019 and 25? Maybe that's one thing you have to consider as an investor. If you want to play around with this sheet, hit file, make a copy. There will be a link to the file down below. They do pay a dividend. I have that going up at about 7%, so about a 2.2% free cash flow yield before market opens, maybe slightly higher after market opens. Kind of a high for a company like Nike. Generally, if you're buying Nike, you're getting a 1.5 to 2% dividend, depending on the timeline. So to trade at a 2.2, 2.4% dividend after market opens, pretty solid dividend yield for Nike historically. As far as their free cash flow goes, a lot of it goes towards the dividend, maybe 50 to 70%, depending on the free cash flow yield of their free cash flow goes towards dividends. The rest, I have it going towards a buyback. They do have some stock-based compensation, a number that has worryingly been growing the last couple of years. So that's an offset to the buyback, but you're still getting a positive buyback yield here. From the perspective of an expected return, what's the right valuation? Again, like I said, it's anywhere in that 3 to 5% range because of the negative 10% growth, because of what we're seeing in the economy and the tariffs and all of that stuff. I'm probably a bit more conservative here. 4%, 50% towards a 4% yield, 50% towards a 5% yield. Again, you can play around with these numbers as you'd like. I get an expected return of about 6.7% at the $71 price point. If it opens at $67 or thereabouts, let's say $68, I get a 7.8% return there. At a 5% yield, that expected return is about 5.8%. If you're more optimistic, at a 3% yield, you're at a 15.6% expected return based on these assumptions, based on this buyback, based on these yield assumptions. If I'm targeting a, let's say, 8% target return before dividends, maybe a 10.3% target return after dividends, I get a fair value that's close to $60, $60.32. That kind of makes sense to me. If I was to want to own Nike, I'd probably need something in that range to start a position. At the end of the day, this is Nike. This is still an awesome brand, a brand that's shown sticking power. In 2008, they barely lost revenue. In 2020, they barely lost revenue. They continued to generate free cash flow. The problem is now their revenue is down 10%. So things, they are changing. There's a lot more competition. I look at some of their competition and the valuation here doesn't seem all that attractive in relation to that competition. I just did a video on Deckers Outdoors. They make Hokas and Uggs. They have a 5% free cash flow yield right now and are growing in the low to mid-teens. Nike, maybe you have a 5% normalized free cash flow yield and you're reducing your revenue by 10%. What's more attractive? Maybe Deckers starts looking more attractive if this is the norm for Nike going forward, because the expectation is that they're going to return to mid-single digit growth pretty quickly based on the call they had. Certainly not happening that quickly because they still talked about the headwinds they're going to see going into fiscal year 26 because of the oversupply of certain franchises, because of the struggles they're going to have in international markets due to tariffs. potentially due to boycotts from some of these other countries. How is that going to impact a company like Nike? Certainly not a positive for them, that's for sure. So as I look at something like this, maybe even a 5% yield is appropriate given all those dynamics, and then you get a fair value closer to $53, maybe even a 6% yield closer to $45. Maybe these assumptions are too aggressive, but for me, I feel relatively comfortable with this brand, this assumption, because again, they have the marketing prowess to get back to growth. They have the money to invest in new shoe releases that are going to kind of compete better against some of these other brands. And we'll see how that works out. Maybe it's going to be tough for them to kind of get back in the good graces of the people that moved to Hoka, that moved to On Running. I am an On Running wearer. My wife is a Hoka wearer. We don't have any items that are Nike in our household. So if I were to own a stock like this, a stock that I don't necessarily like their product anymore, it would have to be a really good valuation. And I'm aware that other people really love their product. I have bought some of their products before within the last year. I bought my nephew some Nike stuff because he likes the brand. He likes some of their products. And again, they do make some decent stuff. It's just, is the valuation attractive right now, even after the substantial fall they saw in the past year, even after the fall they're going to see after this earnings release? I just don't think so, because I'd rather wait to see what happens. I'd rather wait to see that growth return and then invest in the brand if the valuation is still attractive then, because it doesn't seem like that growth is happening anytime soon. Certainly not in Q4 25, and it doesn't sound like Q1 and Q2 26 are going to be all that amazing either, based on some of the negative tonnage I heard during the call. So what do you think? Am I wrong here? Am I wrong on any of these assumptions? Let me know down below what you think about Nike, about the stock, whether you're a buyer, a seller, or a holder. And as always, like, subscribe, and have a good day. Bye.